Hi, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 91 titled Portfolio Overwriting Analyzed. And we're going to be using a real life example with Apple Computer, which trades on the NASDAQ exchange under the ticker symbol AAPL. Well, let's kick things off by defining what is portfolio overwriting. Now, this is a covered call writing like strategy, covered call writing with a twist, if you will. Our goals when we use this strategy is to increase our portfolio returns by a modest amount while still retaining ownership of the shares in that portfolio. In traditional covered call writing, we don't mind if our shares turn over every month or two. Matter of fact, typically they do because we avoid earnings reports. But when we have a portfolio of stocks that we really like and like for the long term, but yet want to generate additional cash leveraging these securities, then we turn to portfolio overwriting. And the way we manage it is we use only deep out of the money call strikes. In other words, we're agreeing to sell our shares at a price much higher than they're currently trading for. And we have to have specific annualized returns in mind. In this particular case, we're going to use 6%, which is a very reasonable amount over and above the normal returns we generate from our portfolios and still be in a relatively safe position. So if we're going to target 6% a year, and that can be tweaked to whatever your goals are, but let's say 6%, then that translates into a 0.5% a month if we're going to use monthly options. So let's have a look now at the price chart of Apple Computer in January 2020. And for those of you watching this podcast, you could see that we have a dramatically uptrending chart. And in the yellow field on the top right of the screenshot shows the time frame that we're referencing now for the January 2020 contracts, which we're going to enter at the end of December 2019. So we have a very bullish price chart on Apple Computer. Once again, keeping in mind that we want to leverage Apple to generate additional premium, but yet we don't want to sell our shares. So this particular portfolio overwriting trade was entered on Christmas Eve, December 24th, 2019, and specifically for a 1-month return. So let's assume now that Apple was trading at 284.27 at the time. Perhaps it was already in our portfolio, or perhaps we bought it on December 24th at 284.27. Now remember, with portfolio overwriting, we're only using deep out of the money call strikes. In this case, we're going to look at the 315 call strike that expires on January 24th, so a full month, and we generated $1.75 in premium or $175 per contract. Now our goal, our annualized goal is 6% a year or 0.5% a month. Now that doesn't mean we're always going to exactly get that amount when we sell our covered calls, but that's our target. So it gives us a frame of reference. We might end up getting a little bit more, we might end up getting a little bit less, but over the course of a year, things will average out to that 6%. Now, first, let me show you these calculations in the multiple tab of the Ellman calculator, and then we'll turn it over to the BCI portfolio overwriting calculator. We'll show you how these play out. Now, if we enter the fact that Apple was trading at 284.27, selling the 315 deep out of the money call strike for 175, 1-month return, it shows you that the return on our option or RU calculates to 0.6%, a little bit more than our target of 0.5%. Now, there's huge upside potential because it allows Apple to move from the current price of 284.27 up to the 315 strike, and that represents upside potential of an additional 10.8%. So that means that in this particular 1 month, we have an opportunity for an 11.4% 1 month return if Apple does in fact move up to and or beyond that 315 call strike. What happened? Well, on expiration Friday, Apple was actually trading higher than that 315 call strike. You remember the chart I told you was a huge uptrending price chart, very, very bullish. And it actually accelerated past that 315 strike and was trading at 318.60. So $3.60 above that strike of 315. Now, before we discuss what we're going to do at that point, I just want to show you the calculations as they look in the BCI portfolio overwriting calculator, and focus in, if you're watching this podcast, on the circled area which was specifically for this trade. And you could see the information was entered, same as the multiple tab of the Ellman calculator. And the results show us that the initial return on the option was 0.62%. It was rounded out to 0.6% in the multiple tab. And that gave us an annualized return of 7.25%. So a little bit higher than our target of 6%. But as I said, sometimes it'll end up a little more, sometimes a little less, sometimes exact, but it'll average out over a year to what our target goal is, as long as we stick to this structured approach. Now let's go back to the status of this trade at 3 p.m. Eastern Time on expiration Friday, January 24th, 2020. Apple, if you remember, was trading at 318.30, and the cost to close was 350. So $3.50. Of that, 330 was intrinsic value. That's the amount that the strike price was under the current market value, which had moved to 318.30 when this screenshot was produced. Now, the cost to close was 350. On first glance, you'd say, whoa, that's like double the amount that we generated from the initial option sale. Was 175. That doesn't make any sense. So if we buy to close the short call, are we losing money? No way. We're not losing money at all. This was a very, very successful trade. Let's have a look at the overview of the trade. For those of you watching this podcast, I put on a lot of bullets here. Usually I don't like to put that many on one screenshot, but this way you kind of have everything all in one place. So as we go over and review this trade, kind of one-stop shopping, if you will. So our trade was in fact maximized to that 11.4% that I alluded to before, the initial premium of 0.6 and the upside of 10.4. So I would have to call that successful, and I would also have to say we're not losing money even if we buy back that short call. So if we do close that call at 350, our shares are no longer worth 315, our strike price obligation, but they're now worth the full market price of 318.30. So even though we're buying to close at 350, on the stock side, we're getting back 330. That means our actual time value cost to close is only 20 cents per share, or 0.06%. Now we could then write, if we buy to close, another deep out of the money call option, once again with that target of 0.5% a month for the following contract month. Now, what if there was an earnings report coming out, which there was for Apple the following Thursday? Well, one of the BCI rules is never to have an option in place that expires after an earnings report. We can hold it, as we would with portfolio overwriting, through the earnings report, and then once the report passes, we can then write the call. So with a stock like Apple and many other blue chip stocks, they do have weekly options associated with them. So what you could do is write weekly options that contract month just skip the week of the earnings report and all will be well. And hopefully we'll have a favorable report. The price will jump up dramatically, and then we could start writing calls after that. However, if the report is not favorable and it goes down, remember, we've already tied ourselves to this wagon. We agree in our structuring of the strategy that we're holding on to Apple for the long term. So it is what it is. Once the report passes, we then start writing calls once again. And if we do use the weeklies, then our target will change, and it would be approximately 0.1% a week. So when we're targeting our weekly options as a result of circumnavigating earnings reports, we change that to approximately 0.1%. You could use that portfolio overwriting calculator and it will annualize it out so you could see whether or not you're meeting your target annualized goals. So if, for example, Apple is trading at 400 and we're using weeklies, we would look to generate about 40 cents for a weekly deep out of the money option. Let's summarize now. Portfolio overwriting is a covered call writing like strategy, and it's geared to increasing returns on our long-term buy and hold securities. We only use deep out of the money calls, and we must have an annualized target return in mind. Otherwise, how do we know what strike to select? We have to figure all this out before we implement the strategy. Now, if a strike should end up in the money, despite the fact that we use the deep out of the money to begin with, we could buy to close, and usually there'll be a minuscule time value debit if we're closing as expiration is approaching. So it's something that we just need a little extra cash reserve to give us that flexibility to buy to close, and then we can move on writing another call the next contract month. Before we close, I just want to remind everybody of the BCI package, which is an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. And it includes 6 online video courses, including portfolio overwriting, 6 calculators, including the portfolio overwriting calculator, and 5 ebooks, including covered call writing alternative strategies, which details portfolio overwriting as one of those strategies. It also gives you an annual subscription to the blue collar investor for a premium membership, which is 13 months. And that has many, many perks to it, too many to mention in this podcast. So it is our best offer to you. You could find it by going to our website, www.thebluecollarinvestor.com. And on any of the pages, just look for the BCI package. Click on that link. It'll give you more details, plus a video explaining all the opportunities you'll have for these educational products. And we do offer a 20% discount when you purchase this package. So, ladies and gentlemen, I want to thank you so much for taking the time to listen to and or watch this BCI podcast number 91, Portfolio Overwriting Analyzed. Hope you enjoyed it. And most importantly, hope it put some cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.